Good day, everyone. So today we are going to tackle about financial literacy. But before we proceed to our proper discussion, let us know first the learning objectives. So at the end of this lesson, the students are expected to design a workable financial plan, apply a principle of savings, investment, and valuing and spending one's value, and know how to become financially stable. So, what is financial literacy? Financial literacy is the ability to understand and effectively use various financial skills, including personal financial management, budgeting, and investing. So, when you are financially literate, you have the foundation of a relationship with money, and it is a lifelong journey of learning. The earlier you start, the better of you will be because education is the key to success when it comes to money. Financial planning, goal setting, and valuing. Financial planning. It is the process of meeting your life goals through proper management of your finances. Financial planning has become an essential aspect of an individual's life. If an individual does not possess an adequate financial plan, then he or she might end in financial crisis and cannot fulfill his or her life goals. Financial planning helps you give directions and meaning to your financial decision. It allows an individual to understand where he or she currently stands and what the desires to achieve and allocate adequate finances towards the same. There are five essential components of a financial plan, such as insurance planning, retirement planning, investment planning, tax planning, and estate planning. Insurance planning. It is the process of carefully selecting insurance policies to financially protect yourself, your family members, assets, etc. against unexpected losses. Includes finding once more insurance providers who can financially support you in case of a crisis. This includes life insurance, medical insurance, and general insurance. So, next, retirement planning. It is the process of identifying financial goals and converting them through building a plan. Retirement planning is to ensure that an individual will be able to maintain his or her current standard of living after retirement. This includes setting your tournament goals, estimating the amount of money you will need, and investing to grow your entire retirement savings. Investment planning. Investment planning means preparing today for your future life so that you can continue to meet all your goals and dreams independently. Investment planning is the main component of financial planning. These plans is met through creating financial resources by investing, savings generated over time. This includes purchasing bond stocks or real estate properties. Now let's move on to tax planning. Tax planning is a legitimate strategy to lessen the tax burden through available tax rebates, exemptions, and benefits. It is the most effective way to counter tax burden, which ensures robust planning of financial goals. There are a number of ways you can go about tax planning, but it primarily involves three basic methods: reducing your overall income, increasing your number of tax deduction throughout the year, and taking advantages of certain tax credits. Estate planning. It is the process of deciding how an individual's assets will be preserved, managed, and distributed upon a death or incapacity. This will make things easier for you and your beneficiaries when the time comes to pass on your valued possessions. It includes evaluating your property and possessions, creating a will or trust, and create designate beneficiaries. So those are the five components of a financial plan. So next is goal setting. Goal setting is a target to aim for when managing your money. It can involve saving, spending, earning, or even investing. Creating a list of financial goals is a vital to create a budget. When you have a clear picture of what you're aiming for working towards your target is easy, that means that your goals should be measurable, specific, and time oriented. So there are several types of financial goal such as short-term goals, mid-term goals, and long-term goals.
First, short term financial goals. These are similar financial targets that can be reached within a year. Example, planning to buy a television or computer, or planning to have a family vacation. Second, mid-term financial goals. Goals are typically take about 5 years to achieve. Example, paying off credit card balance loan, saving for down payment on a car. Third is long-term financial goals. Usually takes much more than 5 years to achieve. Example, saving for college education, retirement saving for a new home.
So now let's proceed to budgeting, spending, and investing. Budgeting. Budgeting is a tool to put you in control of money. A spending plan is also called a budget. It shows how much money you have, where it needs to go to meet your needs and wants, and when you will be able to reach your financial goals. Budgeting is the process of creating a plan to spend your money. Creating this spending plan allows you to determine in advance whether you will have enough money to do the things you need to do or would like to do. Three types of budgeting. First, a balanced budget. A budget deemed a balanced one if the expected government expenses equal the estimated government received during a given financial year. It is a budget in which revenues are equal to expenditures. More generally, it is a budget that has no budget deficit but could possibly have a budget surplus. Second is a surplus budget. The budget presented by the government is considered a surplus budget in case the revenue expected by the government exceeds the expenditure the government makes during a given financial year. Second is a surplus budget. The budget presented by the government is considered a surplus budget in case the revenue expected by the government exceeds the expenditure the government makes during a given financial year. It is when income or revenue exceeds expenditures. Government and companies with surpluses have additional money that can be reinvested or used to pay off debts. A surplus is when you have more of something than you need or plan to use. For example, when you cook a meal, if you have food remaining after everyone has eaten, you have a surplus of food. And lastly, a deficit budget. A budget is deemed a deficit one when the revenue the government expenses exceeds the revenue of the government expect to accumulate in a given financial year. A deficit budget is when the federal government spends more money than it collects revenue. It is generally used when talking about total economic spending rather than the budget of business or individuals. To create a budget, follow these steps. First, identify your net monthly income. Calculate how much money you receive each month. This is the money that comes into your household after deducting taxes, pension dues, insurance, etc. are considered all sources of income. Step 2. Identify your monthly expenses. Monthly expenses include rent, and utilities, as well as those that occur periodically, like car, insurance, and medical expenses. Don't overlook any expenses. Not all your expenses are paid monthly. Step 3. Subtract your monthly expenses from your income. The difference between your income and expenses indicates whether or not you have any money to spare. If you have extra money, you'll need to decide whether to spend or save it. Step 4. Assess and rework your budget. At the end of each month, look over your expenditure to see if they are matching up to your budget. If they are not, determine if you need to work harder to stick to your plan, or if you need to rework your budget to reflect your actual spending.
So now let us proceed to spending. When we say spending, it is when we use money for a particular purpose, especially by a government or organization. Spending is the act of using money to purchase goods or services. It is a key part of personal finance and plays a significant role in the economy. Spending is often seen as a necessary evil, but it can also be a source of enjoyment. The key is to spend money wisely and not let it control your life. These are the benefits and danger of spending. First is the benefits. It can help you buy the things you need and want, which can improve your quality of life. But if not managed properly, it can lead to debt, financial problems, stress, and anxiety. That is why it is important to be aware of the danger of spending and to take steps to avoid them. These are some tips on how to save money. First is to set a budget and stick to it. Second is you can also shop around for deals and discount to get the things you want at a lower price. Third is try a no spend month where you buy only essential for a month and don't buy any want items. So that will be all in spending.
Now, let's proceed to investment. Investment is defined by putting your money to work for you. It's a different way to think about how to make money. It is the process of buying assets that increase in value over time and provide returns in the form of income payments or capital gains. Investment is an asset acquired or invested in to build wealth and save money from the hard earned income or appreciation. Investment is a primarily to obtain an additional source of income or gain profit from the investment over a specific period of time. These include the purchase of bonds, stocks, real estate property. Another is that purchasing a property that can be used to produce goods can be considered an investment. Four basic type of investment options. First is bond. It is a debt security similar to an IOU. Borrowers issue bonds to raise money from investors willing to lend them money for a certain amount of time. Bond is a fixed income instrument that represents a loan made by an investor to a borrower. Second is stock. It is a type of security that allows an investor to own a share or a piece of a company. When a company wants to raise money, it will sell shares of its stock. Stock is a security that represents a fractional ownership in a company. When you buy a company stock, you're purchasing a small piece of that company called a share. Third is a mutual fund. A mutual fund is a company that pulls money from many investors and invests the money in securities such as stocks, bonds, and short-term debt. Um, Mutual fund is a collective investment vehicle that collects and pulls money from a number of investors and invests the same in equalities, bonds, government, securities, money market, and instrument. Lastly is ETF, or we call exchange traded fund, allow investors to pool their money when investing in stocks, bonds, or other assets. However, ETFs differ from mutual funds in that they are traded on the national stock exchange at market prices. ETF is an open-end investment company. It can be bought or sold in 3D at different prices.
So now let's move on to saving and banking. So what is saving? Saving is the portion of income not spent or current expenditures. In other words, it is the money set aside for future use and not spent immediately. Savings refers to the money left over after expenses are subtracted from your revenue, also within a specific period of time. For example, if an individual earns 20 pesos per month and spends 15 pesos per month on consumer goods, they would have 5 pesos left in savings. And then, if you were to lose your job, you should have enough savings put aside to meet your monthly expenses until you can find a new job. So, here are the main types of savings. Although there are a lot of types of savings, but we just list three of the most common savings. First, deposit savings account, money market account, and certificate of deposits or CDs. So, deposit savings account. A savings account is a deposit account designed to hold money you don't plan to spend immediately. A savings account is an effective way to store your money in a secure location where it can earn interest. With a savings account, you can maintain your savings in a liquid state. This includes traditional savings account, high yield savings account, money market account, certificates of deposit, cash management accounts, and specialty savings account. So second is money market account. A money market account is a financial product offered by many banks and credit unions that allows you to safely store your funds while earning some interest. Money market accounts combine some features of checking and savings account. A money market account is an interest-bearing account that you can open at banks and credit unions. They are very similar to savings account, but they are offer some checking accounts features as well. Note that money market accounts are different from money market mutual funds, which are not deposit accounts. So, certificate of deposit. Certificate of deposit or CD is a savings account that holds a fixed amount of money for a fixed period of time, such as 6 months, 1 year, or 5 years, and in exchange, the issuing bank pays interest. And then, when you cash in or redeem your CD, you receive the money you originally invested plus any interest. So, this account is considered to be one of the safest savings options. So, now why is saving important? Saving is important because it allows you to enjoy greater security in your life. Setting up savings goals is a way to help ensure you'll have the money for things you want or need. And now let's move on to banking. Banking is the business of protecting money for others. Banking is a financial institution licensed to receive deposits and make loans. Banking may also provide financial services such as wealth management, currency exchange, and safe deposit boxes. So, banking includes a wide variety of financial institutions that store the money of individuals, businesses, and other entities. Banks provide financial services that help people save, manage, and invest their money. So here are the three types of banking. Again, there are a lot of types of banking, but we just left three of the most common banks in the Philippines. First, retail banks, commercial or corporate banks, and investment banks. Retail bank. These banks offer services to general public and are also called personal or general banking institutions. Retail banks provide services such as checking and savings account, loan and mortgage services, financing for automobiles, and short-term loans like overdraft protection. So, examples of bank in the Philippines: Bank of the Philippine Islands, BDO Unibank, Union Bank, Philippine National Bank, Security Bank Corporation, Metropolitan Bank and Trust Company, Rizal Commercial Banking Corporation, Development Bank of the Philippines, China Banking Corporation, Philippine Saving Banks, and many others. Commercial or corporate bank. They provide specialty services to their business client from small business owners to large corporate entities. Along with day-to-day business banking, these banks also provide their clients with other things such as credit services, cash management, commercial real estate services, employee services, and trade finance. So, the commercial banks in the Philippines are Metropolitan Bank and Trust, Land Bank of the Philippines, Banco de Oro Unibank, Philippine National Bank, and Bank of the Philippine Islands. Investment banks. A bank that provides financial services for corporate and institutional customers, such as investing and raising capital and arranging mergers and acquisitions. The primary goals of an investment bank is to advise businesses and governments on how to meet their financial challenges. An investment bank is a financial services company that acts as an intermediary in large and complex financial transactions. So, investment banks in the Philippines or BPI, ATM, First Metro Investment Corp, BPI Capital Corporation, Asia United Bank, East West Bank, China Bank, and many others. So, banking is important because it plays a central role in the transmission of monetary policy, one of the government's most important tools for achieving economic growth without inflation.
Let's proceed to avoiding financial scams. Financial scams have been around for decades, but in the age of the internet, they're becoming even more common. Financial scams are risk for everyone. They come in a broad array of scenarios by telephone, by mail, by computer, and at the front of the door. And financial scams, older people are attractive targets for scammers because they are likely to have savings and are likely to be more trusting of others. Scammers may lie to you or give you fake information about a real investment, or they make up a fake investment opportunity. Investment fraudsters might say that they are telemarketers or financial advisor. They seem smart, friendly, and charming. They may tell you an investment opportunity is urgent. Here are some tips to avoid financial scams. First, review your accounts. Second, change your account passwords. Third, use online transactions with caution. Fourth, confirm all financial communication. Fifth, check your credit reports. Sixth, monitor your credit. And lastly, properly dispose of documents. First is review your accounts. Check your credit card and banking accounts on a regular basis to ensure that there are no unauthorized charges. Reviewing your accounts will help you to catch fraudulent charges quickly. So, it's very important to monitor your account or mobile banking accounts daily. Second is change your account passwords. Switch out your passwords on a sensitive accounts frequently and make sure not to use the same password for multiple accounts. Changing your account password often reduces the risk that they will have frequent to access. Updating regularly your passwords means that even if someone finds an old or saved password, it will no longer be useful and your data will be secure. Third, use online transactions with caution. When shopping online, always make sure you are using a secure internet connection and avoid using public Wi Fi. Connecting in public Wi Fi is the ability for the hacker to position himself between you and the connection point. Instead of talking directly with the hotspot, you're sending your information to the hacker who then relays it on. Confirm all financial communication. Beware of common scams such as phishing, a process in which scammers send emails posing a bank account and ask you to update or confirm your account information. Always contact your bank account directly to ensure that your account information does not fall into the wrong hands. Also, remember that the IRS will never initiate contact with you via email, text, or social media to demand personal or financial information. Check your credit reports. At least one per year, check your credit report from Equifax, Experian, and TransUnion to make sure all your information is up to date and all your accounts are accurate. Checking regularly your credit reports can help you be more aware of what lenders may see, and it can also help you detect any inaccurate or incomplete information. Monitor your credit. You may also want to sign up for a credit monitoring service, which immediately alerts you to any activity relating to your credit history and accounts. Credit monitoring helps you to safeguard your confidential information from fraudsters. Properly dispose of documents. If you are throwing away old bank statements or other paperwork with sensitive information, such as account numbers, social security numbers, personal identification numbers, and etc., make sure to shred everything before disposal.
Now let us proceed to insurance and taxes. Let us define first on what is insurance. Insurance is a contract in which an individual or entity pays an insurance company in exchange for financial protection or reimbursement of losses resulting from a covered event. To put it simply, insurance is a contract represented by a policy in which a policyholder receives financial protection or reimbursement against losses from an insurance company. The company pools clients' risk to make payments more affordable for the insured. There are three insurance policy components. First is the premium. A policy's premium is its price, typically repressed as a monthly cost, expressed as a monthly cost. The premium is determined by the insurer based on you or your business risk profile, which may include creditworthiness. For example, if you own several expensive automobiles and have a history of reckless driving, you will likely pay more for an auto policy than someone with a single mileage sedan with zero record or someone with perfect driving record. However, different insurer may charge different premiums for similar policies, so finding the price that is right for you requires some legwork. Next is the policy limit. The policy limit is the maximum amount that an insurer will pay under a policy for a covered loss. Maximum may be set per period, for example, annual or policy term, per loss or injury, or over the life of the policy, also known as the lifetime maximum. Next is the deductible. The deductible is a specific amount that the policyholder must pay out of pocket before the insurer pays a claim. Deductibles serve as deterrents to large volumes of small and insignificant claims. So here are some most common type of insurance. First is the home insurance. It is a form of property insurance that covers losses and damages to an individual's residence, along with furnishings and other assets in the home. It also provides liability coverage against accidents in the home or in the property. Homeowners insurance, also known as home insurance, protects your home and possessions against damage or theft. Virtually all mortgage companies require borrowers to have insurance coverage for the full or fair value of a property, usually the purchase price, and won't make a loan or finance a residential real estate transaction without proof of it. Next is the auto insurance. Getting auto insurance can offer reassurance in case you're involved in an accident or the vehicle is stolen, vandalized, or damaged by a natural disaster. Auto insurance is a contract between you and the insurance company that protects you against financial loss in the event of an accident or theft. In exchange for your paying a premium, the insurance company agrees to pay your losses as outlined in the policy. Next is life insurance. Life insurance policy guarantees that the insurer pays a sum of money to named beneficiaries when the insured dies in exchange for the premiums paid by the policyholder during their lifetime. Next is health insurance. Health insurance covers routine and emergency medical care costs, often with the option to add vision and dental service separately. In addition to an annual deductible, you may also pay co-pays, co-insurance, which are your fixed payments or percentage of a covered medical benefits after meeting the deductible. However, many preventive services may be covered for free before these are met. Next is taxes. Let us define what is tax. Tax is a mandatory payment collected from individuals and corporations by a government entity to fund government activities. Taxes are mandatory contributions levied on individuals or corporations by a government entity, whether local, regional, or national. Tax revenues finance government activities, including public works and services such as road and schools, or programs such as Social Security and Medicare. Who need to pay taxes? The taxpayer will depend on the type of tax and associated regulation for the tax. For example, a federal income tax legislation usually only pertains to people who have earned a certain amount of income or a just gross income. We need to pay taxes because taxes are the primary source of revenue for most governments. Among other things, this money is spent to improve and maintain public infrastructures, including the roads we traveled on, and funds public services such as schools, emergency services, and welfare programs. A tax requires a percentage of the taxpayer's earnings or money to be taken and remitted to the government. Payment of taxes at rates levied by the government is compulsory. The tax evasion, the deliberate failure to pay one's full tax liabilities, is punished by law. On the other hand, tax avoidance action taken to lessen your tax liabilities and maximize after tax income is perfectly legal. The following are the types of taxes. First is the income tax. Income tax is a percentage of general income that is relinquished to the state or federal government. Next is the payroll tax. It is a percentage withheld from an employee's pay by an employer who pays it to the government on the employee's behalf to fund Medicare and Social Security program. Next is the corporate tax. Corporate tax is a percentage of corporate profits taken as tax by the government to fund federal programs. Next is the sales tax. Sales tax are taxes levied on certain goods and services varies by jurisdiction. Sales taxes are charged at the point of sale when a customer executes the payments for a good or service. The business collects the sale tax from the customers and remits the funds to the government. Next is the property tax. Property tax is based on the value of land and property assets. Next is tariff. Tariff is a taxes on imported goods imposed with the aim of strengthening domestic businesses. Tariff is a tax imposed by the country on the goods and services imported from another country. The purpose of is to encourage domestic purchases by increasing the price of goods and services imported from other countries. There are two main types of tariff: fixed fee tariff, which are levied as a fixed cost based on the type of item, and the ad valorem tariff, which are assessed as a percentage of the item's value, like the real estate tax in the previous section. And the last is estate tax. Rate applied to the fair market value or property in a person's state at the time of death. The total state must exceed thresholds set by state and federal government. State tax is a tax on the right of the deceased person to transmit his or her estate to his or her lawful heirs and beneficiaries at the time of death on the certain transfers, which are made by laws as equivalent to testamentary deposition. It is not a tax on property.
So now, let's proceed on tips on being financially stable. Financial stable. Financial stability does not always mean wealth, but financial sufficiency as defined by each person. In order to build a financial stability, it normally takes time by collecting enough funds for general living in the future and emergency incidents that may occur. So now, let's proceed on how to become financially stable. First, we have invest in yourself. Having further education, more knowledge, and required skills for work can support your career advancement. In the first step of how to become financially stability, we have to be more knowledgeable. It is also an essential for our living. In addition, having a good health and always maintaining healthy lifestyle will give you more time for income earning opportunities. The second step is make money from what you like. To earn a living with what you like is a good start, as you tend to be happier Bear with it longer and be eager to learn more about it. The third step is set saving and expense budget. Recording your expenses regularly is necessary. This is to monitor your spending pattern and use it for further financial planning. For the basic cost of living, such as housing, utilities, food, and transportation, this should be controlled to not over 50% of monthly income. The fourth one is spend wisely. Even though you earn more, it does not mean that you have to spend more, especially on unnecessary and too luxurious stuff. The surplus you have should be saved and invested so that you can be financially free even faster. The fifth one is set emergency fund. Economic uncertainty, illnesses, and accidental incidents can be happened at any time. To set an emergency fund for yourself, it is a must. The amount for this fund should be around 6 to 12 months. Furthermore, health and accident insurance are recommended too, as it will secure your bank account when you face with expected events. The sixth step is pay off debts. Loans with high interest rate such as personal and credit card loans should be paid off as quickly as you can and stop making this kind of debt again. Non-performing liabilities should be kept at minimum. After clearing all debt, try to be more financially disciplined. You need to limit spending budget for each month and then set aside required monthly expenses and saving amount. The last step is plan for retirement. Some may think it is too far to plan. However, the earlier you can save for retirement, the faster you can be financially free. This is because the savings and returns can be accumulated and continuously reinvested for a longer period of time. For office employees, it is recommended to save as much as allowed by the company in provident fund. In case of moving to a new company, it is better to transfer this fund with you, not withdraw it before the retirement for your own utmost benefit.